أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله الصلاة والسلام على رسول الله السلام عليكم ورحمة الله وبركاته. Welcome to our 20th session. This is the 10th week and we are in the middle of chapter 13. We started to discuss chapter 13 last week and we said there are three activities in the expenditure cycle. They are ordering, receiving, and paying. So we're still in the first activity, which is ordering. Let's continue. The ordering process starts with something called a purchase requisition, which is an internal document. So someone inside the company noticing a shortage of inventory requests the purchasing agent with a purchase requisition, which is sent from the employee to the purchasing agent in the purchasing department. And then the purchasing agent prepares something called a purchase order, which is sent to the vendor or supplier, which is a formal request or a contract to the supplier, sent to the supplier for delivery of specific products at specific prices. And it's a contract in the sense that if they give those products, you have to pay. It's understood that you're going to pay. This is automatically implied. When you go and sit at a restaurant and you order food, the waiter never asks you, are you going to pay? It's understood that you're going to pay. So this purchase order is a contract between the buyer who's ordering the goods and the seller who's going to supply the goods. The purchase order includes the following details of the items that are ordered, order and requested delivery dates. So when do you want them to be delivered to you? The delivery location. If you have multiple branches, you have to specify where to bring the goods. If you have many buildings inside your location, like we have at Qatar University, you have to tell which building to go to, which floor, which room number, etc. Shipping method. Do you want it in your regular shipping method or fast delivery, 3 days, 1 day? You have to pay extra if you have a expedited shipping method. And then names of supplier and purchasing agent. So the supplier's name and the purchasing agent is a representative of the buyer, right? So both of those names are there. So in case there is any communication that is needed, to know who to ask for, who to talk to. Now, these are very, very simple items that I'm going to continue discussing without asking after every slide, do you have any questions? Do you understand? If you do have any questions, please ask them and I will stop and answer them, inshallah. Once you decide on a supplier, like we discussed in our last class, based on the price and the quality and the dependability, after the supplier has provided you with service for some time, you have to evaluate the performance of the supplier to decide whether to continue with this supplier or to change the supplier and get someone else to deliver you the goods. The reason for this is if you keep the supplier unconditionally, then the performance of the supplier may go down and you may have somebody else in the market providing a better good for a better service, for a better price, better good or service for a better price. So you need to wait and see, are their purchase prices or their sales prices are still competitive and good. You have to see rework and scrap costs, meaning if they delivered you damaged goods or if the goods they delivered somehow did not work. For example, you buy phones from someone and the phones are not working properly. Do they take them back? Do they rework? Do they refurbish them? Do they give you your money back? Do they give you a discount? You need to look at that as a part of the performance of the supplier. And then the supplier's delivery performance. Do they come with the goods on time? Do they come with the goods while they are not damaged? All of these are looked at to reevaluate the performance of the supplier, to decide whether to continue the business with them or to change the supplier. And the purchasing function is evaluated based on minimization of costs, including quality and delivery failure. Now, the purchasing agent's job is evaluated based on the minimization of cost while maintaining the quality, right? So whoever is supposed to select the supplier, their job is also evaluated based on how the supplier performs, because they are the ones who selected the supplier and they are the ones who is dealing with the supplier, right? So this is something that is done as well. Now, there are a few miscellaneous things related to ordering. First is there may be multiple purchase orders per purchase request. So you may send an internal purchase request, and because of that, multiple purchase orders may be uh, prepared. So let's say I request a computer from IBM and I request a printer from Dell. So now two different purchase orders would have to be sent, one to IBM and one to Dell. So you may have multiple purchase orders prepared for one purchase request. And there's something called a blanket purchase order. A blanket purchase order is a standing purchase order where you don't have to order the goods every time you need them. So, for example, we have this arrangement in our homes where the trucks come with water and they replace our empty cans and they give us new cans of water. This is called a blanket purchase order. You only set them up to come every week, and after that they continue to provide you with that service unless you stop them. And this reduces uncertainty for the buyer. So you know that every Sunday or every Tuesday the truck is going to come with water. You just put the empty cans outside the door, and it assists the supplier with planning. So the supplier can plan, okay, on Sunday I'm going to go to Al Wab, on Monday I'm going to go to Al Sad, on Tuesday I'm going to Azizia. So they know where to go, when, and who has already placed the order. So they have a schedule and the buyer knows that the goods are going to come. So this is a blanket purchase order. You know, Lulu might have an arrangement with Al Rayyan where the truck for Al Rayyan water comes every Sunday and every Thursday. So like that, they have arrangement with the suppliers. They don't have to order every week. The number of purchase orders processed is a major cost driver, meaning, you know, it takes time and effort and computer resources to process the purchase orders. So the minimization of the number of purchase orders while you order everything you need is also something that uh, is taken into consideration, because the more purchase orders you process, the more it costs you in terms of human resources and computer resources. There's a question that says, is the billing in blanket purchase order, how is it done? Is it prepaid? It could be either way. Right? It doesn't have prepaid or it doesn't have to be postpaid. It could be either way. Right? You could get an invoice after the items were delivered, or you could have prepaid like we have for the waters. We buy the coupons, right? But in the case of, let's say, Lulu, Al Rayyan may send them a bill later, but they just bring the truck and they give them the number of boxes they need, and then they will bill them later. So billing uh, will be prepaid, postpaid. It doesn't matter. Does that answer your question, Sharat? Okay. Now there are a number of things that make ordering easier. For example, use of EDI. EDI is electronic data interchange. You could send the orders electronically, obviously, and many companies do that. It is faster, it's easier. It says use of IT, but these are more than just use of IT. For example, vendor managed inventory. Vendor managed inventory is where the supplier comes and they look at your shelves to see how much inventory you need. So you might go to Lulu and you might somebody there from Baladna looking at the number of bottles of milk, and they are replacing the bottles. So obviously there is a trust between the buyer and the seller where the supplier comes and handle the inventory on behalf of the buyer. So the vendor manages their inventory. This is the case for all vending machines. You may have seen the vending machines, right? They are replaced by the vendor, right? So this vendor managed inventory. There's something called a reverse auction. An auction is when you have one seller and many buyers. So let's say you have a painting and you want to sell it. Whoever is going to give you the highest price, you're going to sell it to them. So this is called an auction. A reverse auction is when you have one buyer and many sellers. So let's say I want to build a building and there are 10 construction firms. So I say, give me a price and a quality estimate. You know, what can you do for me, and how will it how much it will cost you, or how much it will cost me, how much will you charge me? And then I will look at the best bid, the best price and quality combination, and I'm going to select the best contractor. So this is called a reverse auction, when you have one buyer and you have multiple sellers trying to sell you the item that you want to buy. There's also something called a pre-award audit, where you look at the performance of the supplier. This is not a financial audit. So let's say you want to choose a contractor to build your building. You might go and look at a building that they have built a couple of years ago. You want to see the quality of that building. You want to see if the bathrooms are leaking and the roofs are cracking. You want to make sure that everything is working fine. To look at their, or if it's, for example, an accountant, you might want to ask some of the clients of the accountant or the lawyers clients. You might want to ask them to see whether they're getting a good service from them. So before giving them the contract, you might go and check their previous work, make sure that you're getting a good supplier. Okay, so these two items, reverse auctions and pre-award audits, a little bit uh, uh, unusual. Do you understand them? Is it clear to you, the reverse auction and pre-award? All right. Next stage is receiving the goods and storing them. Ali says, no, you don't understand. Is that what you're saying, Ali? Which one do you need me to explain again? Tell me. Pre-award audit. The pre-award audit is, let's say you have 5 contractors and you have this that, okay, I will give the contract to either contractor A or contractor B. And before you to see how they have done in the past. So you might ask contractor A that, can you uh, let me visit one of your buildings that you have built in the, so you visit that building and you ask the people who are there to see whether the building is in good shape after 2 years. Are the buildings, are the walls cracking, or are the bathrooms leaking, to make sure that their work, the quality of their work is good before you actually give them the contract. So this is called a pre-award audit. Does that make sense? Just like you eat a few nuts or a couple of dates before you buy, right? To get the quality. Okay. The next step is receiving and storing. So once the goods are received, right, once the goods are shipped, they're received by the buyer. So you have to decide whether to accept the delivery, whether they have delivered the items that you specified and the quality is good. Accept the delivery, and then you verify the details and prepare the receiving report. So now we have so far 2 documents. The first document is the purchase order, which is prepared by the buyer. The second document is a receiving report, which is also prepared by the buyer. So let's say I ordered 10 computers and they delivered 8 computers. The purchase order will have 10 computers and the receiving report will have 8. Both of them are prepared by the buyer. The buyer is ordering and the buyer is receiving. So the purchase order has the order and the receiving report has all the items that were received. And the delivery person would sign the receiving report as well as the clerk that is receiving, so that everybody agrees that you delivered 8 computers and not 10. And then the items are stored. You verify the details and you store them in the warehouse, and you communicate this to the inventory control function. So the inventory control function is responsible for keeping a record of the inventory. So all the inventory items that are purchased, they're added to the inventory list, and the inventory control function does that. So the warehouse will inform the inventory control function so that they can add the inventory to the inventory records. A few ways you can improve the receiving. Number one, using the barcode. Barcode is obviously, you know, the barcode. When the items are received, they're scanned. There's also radio frequency ID, RFID, right? Radio, we discussed this in previous class. Radio frequency ID are those scanners that you see at clothing stores. Clothing items are tagged with those plastic rings which make a sound if you try to go through that door. So when you're receiving goods, you may have a scanner at the door of your warehouse, and the inventory items may be tagged with the RFID tag. So as soon as the item enters through the door, it's already scanned and added to your inventory. So it makes it faster. You don't have to manually do that. The third, EDI, which is electronic data interchange and satellite technology. And I want to show you something here, a tracking detail of something that I had ordered some time back. And it shows this is a real time when the item is scanned. For example, if you go at the bottom and you see on 3rd of April 2017 at 14:58, the order was processed and ready for UPS, and then it went first to New Jersey, USA, right on the 4th of April at 10:45. Then it continued on its journey again here. You see the next location was Philadelphia, and it was scanned. So this was real time. There is a code up here which was provided to me as well as the person who was going to receive. They could go and track the shipment based on when the item was scanned last time. So you see it went through Philadelphia, and then Laurel, Maryland, and then ultimately Silver Spring, Maryland. It was delivered at 12:38 p.m. and it was left at the front door, right? It was left at the front door. So this is, again, satellite technology that tracks the package. And if you know when goods are coming, where the items are, you can prepare to receive those items. So this, again, helps in preparing the buyer for receiving the goods. The satellite technology helps in that. Okay. Moving along. The third stage is cash disbursement. So once the item is delivered, now the buyer is obligated to pay. They have to pay once the goods are received. Now, the seller also provides an invoice. So we have this third document. Now, we have 3 documents now. The PO is the purchase order, the RR is the receiving report, and we have the invoice. Now, who prepares the purchase order? Who is responsible for preparing the purchase order? The buyer. Who is responsible for preparing the receiving report? Buyer. Who prepares the invoice? The seller. Very good. So let's say I ordered 10 computers, which is in the purchase order. I received 8, and I have an invoice that asks me to pay for 10. How many computers should I pay for? I ordered 10, I received 8, and I get a bill for 10. How many should I pay for? 8. So make sure that the bill is correct. We prepare something called a voucher package, which includes 3 documents: purchase order, receiving report, and invoice. These 3 items are matched to make sure that you're paying for what you received. Most of the time, the purchase order, the receiving report, and the invoice will match. All of them will have the same amount, same number. In that case, you just go ahead and approve and pay. But if receiving report is different than the purchase order, then you will pay for what you received. And the voucher package is prepared to ensure that the invoice is accurate. Once the voucher package is approved, the payment is made. Right? The payment is made. So Atif says that could you pay for 2, prepay for 2? You could do that, but this is not the normal practice, right? The normal practice is you pay after you have received. This is when you have a business between a uh, 2 different businesses. The transaction is between, let's say, Lulu and Al Rayyan. So Lulu is only going to pay for the items that they have received. Right? Of course, there may be adjustments and prepayments and post payments and all of that, but the norm is you receive first and then you pay. Okay, that is the normal course of business. Does that make sense? All sorts of exceptions could be made, but normal course of business is what we are discussing. Does that make sense, Latif? Okay. Now you have 2 methods of payment. The first one is called non-voucher system, which is called pay per invoice. So let's say you order a truck of water from Al Rayyan every week, and they give you an invoice a week, and you pay for that invoice every week, which is called a non-voucher system. Pay for every invoice. The second one is a voucher system where you get the invoices every week, but you only pay once a month. So you get 4 invoices throughout the month, and you make one payment at the end of the month for all of those invoices. Right? This is called a voucher system. This is called a voucher system. Okay, and you could use either one, non-voucher or voucher system, depending on the arrangement between the buyer and the seller. How can we improve the process of cash disbursement? Using of EDI and FEDI. EDI is electronic data interchange, and FEDI is financial electronic data interchange. Financial electronic data interchange is about the sensitive information about the bank account numbers or the card numbers or account numbers of the customer, payment amounts, etc. It's more secure than the electronic data that is just sending an order or a receiving report, etc. So it makes it efficient and faster using electronic communication. Second is automate the 3-way matching among the purchase order, receiving report, and invoice. So instead of manually matching the 3 documents, purchase order, receiving report, and invoice, you could have the ERP system, the enterprise resource planning system like Oracle or SAP do that automatically, especially if both the buyer and the seller are using the same system. So it makes it even easier to match these documents. You could eliminate the vendor invoice altogether. So once the items are received, the buyer could just go ahead and pay for those items. But of course, the seller then would have to trust the buyer to pay for the items that they have received, right? So there is be some level of trust between the buyer and the seller, and then the invoice can be eliminated. One step can be cut, and it saves time and cut steps that are not necessary, that can be avoided, right? So when we decide as business executives whether to have a step or not, we see whether this step has any value that is added. If we remove it, will there be anything lost? Will there be any harm to the quality or the process? And if there is not, we can remove it, right? So elimination of vendor invoices is possible if the buyer and the seller trust each other. The fourth is the procurement cards. We mentioned this, discussed this during our revenue cycle discussion, where I gave the example of Al Jarir. Do you remember Al Jarir having a procurement card for Qatar University employees? Anybody remember that example? Let's say I have a research fund of 5,000 riyal. I can order office supplies from Al Jarir, paper, printers, etc., etc. And instead of going through the purchase order, receiving report, invoice, Al Jarir could give the university a prepaid card or a postpaid card that has a limit of 5,000 riyals, and it specifies what items you can buy with that card. So I could just go to the bookstore, to the store myself, without placing a purchase request and then a purchase order and shipping and delivery and all that. I could just go and get the item. It cuts out all those steps, and then the university could get a bill, but the card would have to be uh, specified. It would have to specify what items can be purchased and what items cannot be purchased. For example, somebody goes and buys a video game with that money, there will be restriction on that. So it would be limited to office supplies. The procurement cards are helpful in that way. Cut out steps and they make the process faster. The last item is budget cash to take discounts. Now, the 2% discounts that are offered if the buyer pays within 10 days, it's 2%. But if you buy millions of reals worth of inventory, 2% could be a lot of money. So if the buyer is careful and take all those discounts, then they could save hundreds of thousands of reals, which will add to their profit, right? Are you following? Any questions on this slide? We have a few things in this slide that you might have questions with. Is this clear? Do you understand? Okay, very good. We come to the last slide for today. We have the corruption and fraud that can be done in this business cycle. The first one is kickback. Now, all of you should know kickback because there was a question in the last exam about kickback, right? The purchasing agent receiving a an amount from the supplier for selecting the purchasing agent. For every time the company buys something, the supplier kicks back money to the purchasing agent. This is unethical. This is fraud. It should not be done. And the second is conflict of interest. So let's say the purchasing agent has one of his relatives who's one of the potential suppliers. So when he's choosing from the 3 suppliers who have offered to sell, he might choose his relative. So there is conflict of interest. If there is a situation like that, the supplier, the purchasing agent should excuse himself and not select the supplier, let somebody else do it. The third situation is economic extortion. Economic extortion is when the vendor is asking for bribe. Now, this is a strange situation when the seller is asking for rishwa, is asking for bribe to sell it to the buyer. And this can happen when you have multiple buyers for the same item. So let's say there is a hotel and the hotel has a spot for a coffee shop. A 5-star hotel has a spot for a coffee shop, and only one coffee shop can get that spot. So it could be either Starbucks or Tim Hortons or Coffee Bean and Tea Leaf, any one of those shops, but it could be only one. So if all of them want it, the manager of the hotel could say, okay, whoever's going to give me the highest amount of money, I'm going to give it to them. The owner of the hotel may not even know that this is going on. So the manager might take advantage of the situation where he's just supposed to give it to any one of them. He might demand money from one of them, and this is called economic extortion, when the vendor is asking for bribe before he would decide who to sell it to. Does it make sense? This is a strange situation, but it happens. Does it make sense? Okay, and then we have the last item, which is illegal gratuities or gifts. Now, sometimes the supplier may give The vendor may give just a gift without saying anything, and that's something that the purchasing agent should not accept, even if the supplier does not say anything or demand anything, because it automatically makes the heart of the purchasing agent softer for that particular supplier. And usually there are company policies that say that you're not supposed to accept expensive gifts from the supplier, etc. Now let's say the supplier is supplying, bread and cake and so forth, and he gives you a piece of cake, right? It's 1 real worth of item just to eat, for you to eat and so forth. I mean, this is not something that would change your mind one way or the other. This is something, maybe the cake is just baked, it's hot, and they says, just try this. This is very good today. This is not an illegal gratuity, but an expensive gift that would change your mind or soften your heart to do something, some business with the supplier. That is something that should not be done. All right. Any questions on what we discussed today? Okay, now I have intentionally made these few lectures shorter because you can have some time to ask me questions about the product, the project. Hadisa says the internal audit has studied that even small cake is not allowed. So now, if you're talking about the case of an auditor, that's a different story. Right? If you're talking about the case of an auditor, that's a different story. The auditor must be independent, right, in both appearance and in act. So the auditor's case is different. When you have the purchasing agent, his case is different with the supplier. All right. Even this is theory. What you studied, Muhammad Isa, is theory, right? This is theory. Reality is not exactly that, right? Reality is different. There is a certain amount of reasonableness in transactions. So if you go to your client and they offer you lunch, every auditor eats that lunch. You follow? That does not take away from their independence. This is the reality. Okay? Does that make sense? Right? So what is exactly in the book is not exactly what is practiced. There is a certain industry norm, there is a certain professional norm. It's written in the book when you're driving a car that when the yellow light comes on, which one of the foot pedals are you supposed to press? When you see the yellow light, what your foot is supposed to press? Brake. When you see the yellow light, in reality, what do you press? Muhammad Isa. So if you have worked, right? If you have worked as a professional, if you have industry experience, you will know that what's written in the book is not exactly what happens. But of course, there is norm. I mean, there are ethical norms in the industry, that in the profession, that is followed by the professionals. So it is not opposite of what's written in the book. It's not exactly precisely how it works in the real world. Does that make sense? Great. Now tell me, do you have any questions about the project? I've received some good questions from the group leaders, and I have tried to answer them on time. But if you have any questions, I left this time intentionally. If you have any questions, I could answer them during the remaining time. Any question? Now, we are in the last 4 weeks of the semester. This is the 10th week, so we have 4 more weeks left before the final exam starts. In 4 weeks, you're going to be in 2 weeks, actually, 2 or 3 weeks, everything is going to start to become due, and you have to submit. The due dates are going to come, and you have to submit many things in many courses. So you have a relatively easier time right now. The best best thing to do is use this time and prepare for the final exams. Work on those projects early, that you are not overwhelmed and stressed at the end, right? This is the advice I give to my children, and you're no different. I'll give you the same advice because your success is important to me. So if you need any help from me, anything I can do for you, please let me know. And I'm giving you some time, today, and I will try to do that a few more times so that you can utilize this time to work on your project. You can ask me questions during this time as well. Okay. If you don't have any questions for me, you can just go and continue working on your group projects in this course or any other course. Continue use this time, inshallah. Okay. All right. If you don't have any questions, I will see you next Sunday, inshallah. Assalamu alaikum wa rahmatullahi wa barakatuh.